Hello, can you guys hear me? All right, can you guys hear me? Let me do a sound check before I start. All right, I'm just gonna send a poll out. So if you can hear me, just give me a response. You can type yes or no. I mean, click yes or no essentially on that pop-up there. So all right, so I'm seeing a lot of yeses. Yes, yeah. So I'm pretty sure that my mic is clear. All right, so let's just get straight into the webinar. All right. All right, so hi, good evening, everyone. My name is Brian, and I'm going to be your host and speaker for tonight's webinar. I'm a leader here at Phillip Capital, so if you have any questions about trading products or just anything about trading, do reach out to me and let me know, yeah? All right, so let's just get straight into it. Hold on, let me show my screen real quick. Give me a second, yeah? All right, so here it is. All right, so let's just get straight into it. All right, so this is just a disclaimer that this presentation has not been reviewed by the Securities Commission Malaysia, and it is not a recommendation or an offer to purchase or sell any of the products listed in this presentation. This is just for educational purposes only, and hence PCSB or Phillip Capital Sdn Bhd is not liable for any of the actions or investment decisions that you may make based on this webinar. You are recommended to seek advice from a qualified financial advisor before making any risky decisions. All right, so let's just get to know a bit about Phillip Capital. So we were incorporated on the 7th of October 1995, and we are a wholly owned subsidiary of Phillip Capital Holdings Sdn Bhd. You may formerly know us as Phillip Futures Sdn Bhd, but we've since changed our name because we started to offer a wider range of products. We are a trading participant as well as a participating organization of Bursa Malaysia, and we are also a holder of the Capital Market Services License, the CMSL, which means we are regulated and legally allowed to provide financial services and products to you all. All right, so we have a total of 11 Phillip Investor Centers, also known as PICs, across Malaysia, with our headquarters located in Kuala Lumpur. And if you are in any of the areas of these PICs, you are welcome to drop by and say hello. We don't bite, it's okay. You know, we are pretty friendly, to be honest with you. Okay, so I'd like to take this chance to thank our clients for allowing us the chance to be able to win multiple Bursa Excellence Awards throughout the years. And just recently, we have won the first runner-up for the Best Retail Derivatives Trading Participant, as well as the second runner-up for the Best Overall Derivatives Trading Participant. So thank you all for that. So we have a wide global network. We are located and incorporated in 15 different countries, which allows us to have a wide global coverage. We have access to exchanges in the US, such as the CME Group, in the in Europe, such as the Eurex, as well as the ICE exchange, and as well as Asia Pacific exchanges such as Bursa and SGX and Tocom from Japan. So that means that if you wish to trade any of the products listed in these exchanges, you can do so through us. All right, so we are a one-stop solution for trading because we offer a wide variety of products. We offer futures such as index futures and agricultural futures, all the way to the good old shares and stocks, such as Malaysian shares or foreign shares like US shares and Hong Kong shares, as well as contracts for difference. So if you are into that, or into any of these products, we offer all of them. All right, so we are your broker of choice mainly because we are an award-winning broker. We offer 24-hour broking and execution support. We also offer advisory services as well as the latest market news to our clients, a wide array of products, as well as an easy process for online account opening. So for the advisory services, we actually have this program called Learn with Phillip Capital, where we provide free one-to-one coaching sessions for our clients, as well as free seminars and webinars free of charge, and a free process for online account opening processes. For our free one-to-one coaching sessions, we kind of go through the product knowledge, which is basically the introduction to futures, CFDs, or stocks, as well as our charting system, which is basically just a session for platform coaching. So if you're interested in any of the seminars and webinars, do scan this QR code to register for any of our upcoming events. This is our weekly market call, where we have weekly market views and updates, as well as weekly live counter technical analysis, and both of these are conducted on a weekly basis. So if you're interested in that, do scan these QR codes to get involved in that. All right, so to enjoy a hassle-free online account opening process, do scan this QR code if you're interested in opening a futures account or a CFD trading account. All right, let's get to know the trading platform. So first off, we have Phillip Nova, which is our trading platform for futures. We have all the good stuff like 90 technical indicators. We have the market depth trading tool, and all of this can be found on Phillip Nova. So that's a big ups to you if you are trading futures. All right, we also have a stock trading platform. We have two. One of them is Holmes Global MY for foreign shares, and the other is Phillip Trade for local shares. So if you're interested in stocks, they are both available on both the App Store, the Apple Store, as well as the Google Play Store. And lastly, we have our Phillip CFD Trader, which are for people that are interested in trading CFDs. All right, so now that we have the introduction out of the way, let's get into our main content for tonight. So this is our content outline. We have, what are futures? First off, I'm going to bring you through the introduction to futures. Then I'll bring you through an introduction to the Kuala Lumpur Composite Index futures, the FKLI, as well as the crude palm oil futures, the FCPO. Next, we'll learn about the benefits of trading futures, as well as, further breakdowns of fundamental analysis, as well as technical analysis, which is personally my favorite. All right, so before we start, I'm just gonna drink one sip of water, if that's okay with you. All right, let's get started. So what are futures? Good question. So essentially, futures contracts are agreements to buy or sell a particular product, such as a commodity like gold or a financial instrument, for a specific price on a predetermined date in the future. The reason it's called futures is basically because you are trading the price of something in the future. Like you're trading the price of Coke, for example, that is expected in the future. So that's why it's called futures. And futures contracts are essentially standardized agreements that are typically traded on exchanges like Bursa Malaysia, the SGX, or the CME Group. Standardized meaning that it doesn't matter who you are or where you're from or what time you're trading, you are going to be trading the same product as the same contract with the same terms, as long as it's the same futures contract with an exchange. All right, so this is an example of a futures contract. Here we have the details of the agreement between the buyer and the seller. We have a seller of corn, they're trading 25 bushels of it at a price of $5, and we have the delivery date, which is also known as the expiration date. So it's on the 1st of July, so guess what happens when that date reaches? On the 1st of July, we can see that the transaction occurs, which means that the seller sells corn to the buyer, and the buyer finally pays the seller his money and buying the corn, right? So this is kind of like the transaction of a futures contract. Well, actually we have a ton of futures products. It's not just corn. We have agriculture futures like the crude palm oil, wheat, and corn. We also have index futures like the big old S&P, as well as the Dow Jones, and energy futures like gasoline or crude oil, metal futures like silver, copper, and the good old gold. Everyone loves gold, so it's a pretty popular product, I'm not gonna lie. So by standardized terms, remember how I told you it doesn't matter where you're from or who you are or what time you're trading. If you're trading a futures contract, the terms are all standardized. And these terms that you see on the screen right now are extremely important terms of a futures contract. And I will go through each of them in more depth later on in the presentation. But first off, I want to bring your attention to the settlement method. Essentially, there are two ways to settle a futures contract. The first one is a cash settlement, which means that at the end of the contract, the holder of the position is simply debited or credited the difference between their entry price and the final settlement. Essentially, it means that at the end of the trading month, you are going to go to your trading account and you're going to see if you won or lost money. No physical transaction happens. The physical transaction is only for contracts that are settled in physical delivery, which means that at the end of the contract, the holder of the position will either have to deliver the physical commodity if he was a seller of the contract, or take the delivery if he was a buyer of the contract. So if you are a buyer, for example, of, say, crude palm oil, you actually are legally obliged to go to a harbor somewhere and pick up your amount of crude palm oil. And unless you are a producer, I'm not really sure what you're going to use it with that amount of crude palm oil, but that really happens if you are a retail trader, because we do have measures for that. All right, so next up we have, what is crude palm oil futures, or also known as the FCPO? So the FCPO is a crude palm oil futures contract denominated in the Malaysian ringgit and traded on the Bursa Malaysia Derivatives Exchange. It is Sharia compliant and has been providing a global price benchmark for the crude palm oil market since October 1980. That is quite a long time. It is widely used by players in the edible oils and fat industry, as well as by fund managers and financial institutions for managing price fluctuations as a risk management solution. Wow, a lot of big words. But for people like you and me, we are called retail traders, right? We essentially are involved in the market to speculate and trade for profit. So simply put, that's our role in all of this. So now we have the contract specification for crude palm oil. All of these were the terms that I said I would go more in depth in this part. So first, the instrument is based on crude palm oil, obviously. The contract size is 25 metric tons. It means that if you're trading one contract, you're trading 25 metric tons worth of crude palm oil. And that 1 metric ton is around 1,000 kilograms, so that's a lot. So for example, right, let's just say the CPO is trading at around 6,500 ringgit, right? The contract value, you just take that 6,500 times 25 metric tons, and you get that total of 162,500 ringgit. That's the total contract value, right? The minimum price fluctuation is 1 ringgit per metric ton, and the value per tick is 25 ringgit, meaning that each time the market moves up or down, the minimum value it can move up is 25 ringgit. So for example, here, let's just say you sold FCPO at 6,500. And if you are a seller, if the market goes down, you earn money. So let's just say it moves up by 1 ringgit, and 1 ringgit is worth 25 ringgits. So you would have lost 25 ringgit, but if it moves down by 2 ringgit, you would have earned 50 ringgit. So that's just kind of like the relationship between buying and selling, as well as the tick movement. The trading hours are listed down below, so make sure you get that right. And the final trading day is that the contract expires at noon on the 15th day of each delivery month. So you gotta keep that in mind. The initial margin is 9,000 ringgit. So that means that to be able to trade one contract of the FCPO, you need a minimum of 9,000 ringgit. All right, so these are all the contract specs for the FCPO. Let's move on. Okay, so we are now at the Kuala Lumpur Composite Index, also known as the FKLI. So what is the FKLI exactly? Well, the FKLI, or also known as the FTSE Bursa Malaysia KLCI Index, it represents the top 30 companies by market cap on the Bursa Malaysia main market. So what that means is that an index is basically a basket of shares. You have 30 different shares of each of different companies put into one basket, and then they get the weighted average of all of that. So a good thing about that is if you're trading the FBM KLCI, there's no need to pick individual stocks. And as you can see from this example right here, we have the top 30 companies as of that specific date. You have Maybank, you have IOI Corp for example here, you have Public Bank, and you have the good old Mr. DIY. Everyone loves Mr. DIY, so that's also in here as well. So let's move on to the contract specs for the FKLI. So it's based on something a bit different than what we saw in the previous slides. It's not based on a physical thing. It's based on an index which you can't see. It is called the FTSE Bursa Malaysia Kuala Lumpur Composite Index, and that's what it's based on. So the contract size is the FBM KLCI times 50 ringgit. So for example, if you're trading one contract size, the contract value is you take the KLCI price, you times 50 ringgit, so you are getting a total of 80,000 ringgit worth of contract value, right? The minimum price fluctuation is 0.5 index points, and the value per tick is 1 ringgit. So what that means is that, for example, let's just say once again you sold the FKLI at 1,000 ringgit, right? If price moves up from 1,000 ringgit to 1,001 ringgit, you lost 50 ringgit. And if it moved down by 2 ringgit, you would have earned 100 ringgit. That's what the example kind of showcases the price movements and what it might do to your position. So it is cash settled because you can't physically deliver something that you can't touch. And it's different from the FCPO that we saw in the past. The trading hours is down below here. We have 3 sessions, and we have the final trading day, which is at the last business day of the contract month. The initial margin for this is 4,500 ringgit, which means that to trade one contract, you need 4,500 ringgit to trade one FKLI contract. All right, now that's all for the FKLI. Let's move on to the next section. why trade futures? What's the benefit of trading futures that gives you reason to not trade other things? What's so good about futures? Well, firstly, we have leverage, right? Which means that you are able to trade a contract value with a big size for only a portion of that money. Second, you have high liquidity, and third, you have bi-directional trading, which means you can go long or short. And lastly, you have low transaction costs, which just means it's cheap to trade the futures contracts. So a more in-depth look at leverage, it means that you can use a smaller capital upfront to trade a greater contract value, which is normally around 5 to 20% of the full contract value. But it's a double-edged sword, because a small movement in the market can translate into a big movement in your portfolio. Now, for example, look at the right for a second. Look at the cash market, right? In the cash market, let's just say the KLCI is traded at 1,600 ringgit. Again, the total contract value is 80,000 ringgit. It means to trade the KLCI in the cash market, you need 80,000 ringgit at that price point. But translated over to the FKLI, the futures market, you only need 4,500 ringgit on the left, right? That means that you are trading the same contract value, but you just need less money to trade. An example of using leverage is that, let's just say you are a buyer, right? When you buy something and then the price goes up, you earn money, right? So let's just say you bought FKLI at 1,600 there, and it moves up by 30 points. And you sold or you close your position at 1,630. You made profit, right? Great. You made 1,500 ringgit as you take the 30 points times each point is per 50 ringgit, so you get that amount of profits, right? Compare that to if you were to trade on the cash market on the top there, you would have only made an ROI of 1.88%. But look at the futures market, you would have made a ROI of a whooping 33%, which is a really big amount. But remember, this is just the example for profits. It's a double-edged sword, because look at the next example. Let's say you bought, right? You bought at 1,600 and it went down by 20 points. The market's not in your favor. I'm sorry. And you close your position at 1,580. So you lost 20 points, which equals to a loss of 1,000 ringgit. All right. In this case, if you were to trade in the cash market based on your capital, you only lost around 1.25%. Not that bad, right? But in the futures market, you lost a total of 22% based on your initial margin of 4,500 ringgit, which is a pretty big loss of ROI. So it's a double-edged sword. It allows you to trade big contract values, but at the same time, it depends on how you use leverage in itself, because it can either get you really big profits with small capital, or it can cause you to lose big money using small capital as well. So just to keep that in mind, it is a risky endeavor indeed. And secondly, we have high liquidity. So high liquidity basically means it's easy to enter and exit the markets, and you should have no issues with any other positions, right? You have smaller and bid-ask spreads. Now, what liquidity means is, think of it like this. You want to buy an iPhone, right? But there's like 10 people in your town, and the only person that wants to sell it to you wants to sell it to you at 2,000 ringgit, but you only want to buy at 1,000 ringgit. There's not enough sellers for them to compete, so he can put the price as high as he wants to, which means that for you to be able to buy an iPhone, you have to fork up a lot more money than you wanted to. This is the same example here. Say in the FCPO market, if you look at that red column right there, you can see the bid and ask price. The bid and ask price is essentially the price at which the buyers are willing to buy, which is the ask price, and the bid price is the price at what the sellers are willing to sell. So you can look at the difference is only 2, and then the same goes for the FKLI. You have the bid and ask price, and the difference is a whooping 0.5. So you can see that you are going to be able to enter your positions at a better price, closer to what you initially wanted to enter them on. So that's what it means by high liquidity. And third, we have the bi-directional trading, which means that if you trade the futures contract, you can go long, which is you can be both a buyer as well as a seller, or go short, meaning that it doesn't matter what trend it is, if it's an uptrend or a downtrend, you can captivate on that and then take advantage of the market movements. Because, for example, in some countries, you are not legally allowed to sell a stock. That's right. If you trade stocks, you cannot sell stocks. You can only buy stocks in certain countries. So for futures markets in Malaysia, that's totally fine. There's no issue with that. And we have low transaction costs, which means that the transaction costs for the futures market are quite cheap compared to the share market. We have a fixed fee per lot per site rather than a percentage of the contract value that we see in stocks. So this is just an example. You can see that the commissions or the transaction cost for futures is significantly lower than that of stocks. But keep in mind, it's just an example. It's just to serve as an illustrative example. Sorry, tongue, I got my tongue right there. So now we have the regulated markets. Basically means that the futures markets, they are regulated by multiple government bodies as well as industrial bodies, and this provides fairness and transparency. Now we have the Ministry of Finance overseeing the Securities Commission, which then oversees Bursa Malaysia, and then they oversee us as a brokerage firm. So it's quite safe compared to many offshore brokers, and the market itself is safe for you to keep your money in, basically. All right, now let's get into the part of the analysis. What are the fundamental factors that affect the FKLI as well as the FCPO? So, what is fundamental analysis? So it's essentially a method of evaluating a security, such as a company share, maybe like Maybank shares, or foreign exchange currencies, by analyzing the underlying factors that affect its price. We're saying things like company's financial statements, what's the condition of the economy, is it strong or is it bad, and things like industry trends. These things are what people look at when they conduct fundamental analysis, depending on the product itself. So for example, here we have Maybank, right? This is Maybank's annual report, and people are going to be looking at this segment essentially to look at the financial strength of Maybank to determine if they want to invest in Maybank or not. Of course, this is just an example, and we have multiple factors that affect the FKLI. Things like the Malaysian data for our economy, things like the GDP or the inflation rate, the employment data. All of these are metrics that kind of show to you like how strong is our economy. Are we growing? Are we like declining? What state are we in right now? Should we be investing in the economy? And we also have things like the corporate earnings result, things like the company's financial performance, like what we saw just now in Maybank. People will use that as forward guidance to kind of look at what the future entails for a certain company. We also have things like the global stock market performance, things like the US indices as well as China index, because we are also affected by these factors, as well as the last geopolitical issues like the US to China trade war, which I'm surprised is still ongoing. It's been a while now, to be honest with you. And we also have the recent Ukraine-Russia war, as well as other uncertainties like COVID. When COVID hit, that if you were in the markets, that was quite a time to be alive. It was a roller coaster, to be honest with you. So, all right, so the FCPO is based on crude palm oil, right? So these are the factors that affect it. And because the crude palm oil is something that has a physical form and people use it to produce things, it is mainly affected by things that will change supply or demand factors. For example, we have the weather season like the La Nina or El Nino, and these showcase adverse or really bad weather conditions for palm trees to grow. So if palm trees are not growing well, then the supply is going to be cut short because they can't produce palm oil, right? So if demand stays the same and supply decreases, essentially the price will increase because everyone wants something that's rare, right? And next we have the country import and export volume, things like what's the Like how much is Malaysia exporting compared to importing, all of that stuff, because it's going to kind of affect investor sentiment. So these are just factors that affect the supply and demand of FCPO. We also have the competition from other edible oils like soybean oil or sunflower oil, as well as the time of the season, like the festival seasons, like Deepavali, Hari Raya, and how much are people going to be using something in this period of time. So all of these factors are things that affect the FCPO. So these are just a few examples of that. All right, next we have my favorite part, and as you may know, I'm a technical analyst. So all of my trading or analysis, most of it at least, is based on parts like this. So what is technical analysis? You've seen people online posting pictures of their iPads or their iPhones or their phones, and you're seeing bars and lines and charts. But what are they? What do they mean exactly? Well, technical analysis is essentially a method of analyzing the financial market data to forecast future price movements, right? We use historical price charts and market statistics to identify patterns and trends. And what that means is that we're looking at something like this. What's that? What's red and what's green? What is this, right? So this is a chart that most people nowadays use. It's called a Japanese candlestick chart. And it looks weird. I know it looks weird, but check this out. What's this? Do you remember like back in like school when we had to like draw lines and things, right? And essentially this is a simplified version of that. We have the x-axis, which is the horizontal line, which represents time, and we have the y-axis, which represents price. So from this example, we can see that price from 9 a.m. to 10 a.m. it went up to 2 ringgit and then dropped back down to 1 ringgit, and then from 10 a.m. to 11 a.m. we rose up to 3 ringgit. So we are seeing what the price did as time goes by, right? And if I were to change or paste this onto the previous slide, it looks like this. So it looks similar, but it still doesn't answer the question of what those bars are. Now you have the idea that, okay, I know that this chart represents time and price, but what are those little things, right? What's that red line and green line? So essentially, those red lines and green lines are what we call candlesticks, right? Because they look like candles. And basically, the candlesticks show the price movement across a certain period of time. So we have the red candlestick, which is called a bearish candlestick. And we have the green candlestick, known as the bullish candlestick. So the red candlestick, the bear, essentially shows that price went down in that time period. And then the green candlestick, which is the bullish candlestick, shows that price went up for that period. You can see right here. So just to break it down just a bit more in depth, we are going to go through a class of candlestick anatomy, which I kind of like break through the different body parts of the candlestick. So in this example, we have a bullish candlestick, right? So it's made out of 4 main parts. First, we have the open down below, which is the price that the candlestick opened at, and then we have the close, which is the candlestick that the price that the candlestick closed at. We then have the high, which is the highest point, as well as the low, which is the lowest point that the candlestick traveled to. Now, a bullish candlestick shows that a price went up, right? So the open has to be below the close, or put it more frankly, if price went up, it has to close at a higher price than the opening price, yeah? So basically, this just means that a bullish candlestick has to have a higher close than the open. The high and the low doesn't really matter in this context. And the thin part of the candlestick is called the wick or the shadow. I prefer to call it wick because it's a cooler name and it's easier to pronounce, so I call it wick. And then the thick part, the really thick part, is called the real body. It's essentially the distance between the open and close, and then the wick is the distance between the close and the high, or the open and the low. So this is kind of like the main parts that the candlestick is based off. The same example applies on a bearish candlestick, but with a twist. The twist being that the closing price of a bearish candlestick has to be below the opening price, because price went down, right? It has to close below its opening price. And everything's the same. We have the open, the high, the low, and then the close is all the same thing. We also have the wick and the shadow, and as well as the real body, the thick, juicy part. So this is essentially the body parts of the candlestick, and the candlestick charts showcase a very detailed price movement across a certain time period compared to a regular line chart. Because here we can see where price opened at for the candlestick, we know where it went to, where we didn't go to, and all that stuff is condensed in a Japanese candlestick chart. All right, so here we have the technical analysis part for premium and discount, as well as gaps. And these two concepts are something that I use every day in my analysis. So let's just get straight into it. So premium and discount, right? Think of it like this. If you're a seller, you want to sell your things at as high as a price as possible for higher profits, correct? And if you are a buyer, you will want to buy at an extremely low price for a better bargain. It's not to say you're buying things at cheap, but you want to buy things for a better bargain, right? So it's the same thing as at a market, but on the charts, we are using technical information to determine if an asset, such as a stock or futures, is oversold or overbought, or if it is in premium or discounted pricing, because you want to look for areas to be able to sell and buy at. So for example, here we have the current weekly candle, which is the one that has the arrow pointing at. We are going to base our premium and discounted areas on the previous weekly candle right here. So you have the candlestick open, you have the close, the high, as well as the low. It is going to be that purple circle. I'm just going to extend it out so you can see that we have the open, close, high, and low, just like the previous slides. So in this example, the best place to look for shorts is in premium pricing, which is denoted in red. The best place to look for longs is in yellow, which is also discounted pricing. And in between that is orange, that is what we call neutral pricing. And it is going to be a place where everything's fair value. It's not really too expensive or too cheap to buy in. So we may not want to look at those areas to be our trades to be based on. So this is the weekly time frame, meaning that each candle that you see right here represents the price movement of 1 week. Now, if we zoom in to the 4-hour time frame, essentially we're zooming in and putting everything big. Each candlestick that you see right here represents price movement for 4 hours, right? We have seen this this distance is around 1 single week. So remember, the best place to look for shorts is in the red, premium pricing, and then the best place to look for longs is in discounted pricing in yellow. Now let's look at what happened. So number one is that we have this purple box, which is the weekly open. This is where price opened at for this week. And we are basing these levels based on the previous week. So from number one, we went up to number two into the red zone, which is our premium pricing. And then look what happened. We sold off. We came down all the way into discounted pricing, which is the third zone, the yellow zone, and then we went out from there. All right, so this is what happened for that week. We went up into premium pricing, sold off into discounted pricing, and then went up. So essentially, if you were to use that logic of selling at premium, you sold in the red, you would have made a profit. And then if you were to use that concept of buying in discounted pricing, you would have bought in the yellow zone right down here. But keep in mind that it's only a concept. And it's only a confluence for you to use with your overall strategy, because what's more important is your trade context. It is just a way to filter out and find better trades, but it itself is not enough to be your entire trading strategy. Your trade ideas and your strategy should be based out of multiple rule sets and not just one. You need multiple confirmations. All right, so I'll help you with that, because in the next slide, I'll go through my personal favorite entry criteria. So we have what we may call a fair value gap. So this may not be something that you have seen. It's kind of different from the typical support and resistance, but these zones are just areas of support and resistance, you know. So a fair value gap is formed by 3 candles. Now we have the first candle in red, and then the second and third candles in green, right? So in this case, this is a bullish fair value gap example. It is formed by taking the high of the first candle, you know, the highest point that it went to, the highest point of the first candle, and then you look at the lowest point of the third candle, and you might see that they do not touch, right? And if they don't touch, that then forms a gap, which I refer to as a fair value gap. So this gap is known to be an area of high volume and inefficiency, which means that the price is too voluminous, it was too quick, leaving some orders unfilled, in this case, sell orders. So essentially what that means is that price is too quick, it left a gap. Okay, now the logic behind this is you think of it like this. If you went to a market, like a pasar, and then you wanted to buy something, right? You wanted to buy something, but because it's too loud, it's too noisy, there's so many people there, people don't hear you, and then they miss out on your order. You know, so essentially, this creates a gap. You are that gap. And then the market has a tendency to come back to these areas to find support or resistance. Support being an area where the price will bounce up to go higher, and resistance will be an area where the price is finding trouble breaking through. Think of a support like a trampoline, and think of a resistance like a wall. So this example is an example of a bullish area of support. So next we'll go look at an example of a bearish fair value gap, which is resistance. So it's the exact same thing as the bullish example, just reversed. We have 3 candles, 1, 2, 3, and then we will take the low of the first candle and then look at the high of the third candle. If they don't touch, then there is now a gap, which is in purple right here. Now this is a resistance, and we are looking for price to come back to these areas to then sell off. All right. Now we have examples coming right here. So this is an example of a bullish fair value gap, which is a support. Now in the first example, we have 1, 2, 3 candles, and then they do not touch. The high of the first candle do not touch the low of the third candle, and then guess what happens? Price left it and then came back on support and then left again, right? And then now we have the next example, which is the first candle, second candle, third candle. Look at how the high doesn't touch the low of the third candle. This is support, price leaves it, and then comes back down, and then rockets up. So this means that a bullish fair value gap is an area of support that you can look to enter longs off of. Now we'll look at the last example for the bullish, for this slide at least. We have 1, 2, 3 candles. The first candle's high doesn't touch the third candle's high, low, sorry. So now we expect the market to come back down to these levels to push off to go higher. All right, here we have a bearish example of a bearish fair value gap, which is an area of resistance. See how we have 1, 2, 3 candles again. The low of the first candle doesn't touch the high of the third candle, and then price lifts it, comes back up, and then sells off into oblivion. So this acts as an area of resistance. There's actually one more fair value gap down below, which is here. And we have the first candle, second candle, third candle, same thing. As long as the candles do not touch, we now have what I call a fair value gap. And then I'm expecting the market to come back to retest the zone and then sell off as a resistance. All right, we have more examples here. First, second candle. It doesn't matter what candles they are. It doesn't matter if they're bullish or bearish. As long as the candles do not touch, it is a valid fair value gap. You know, we have 1, 2, 3 candles. That gap in between forms a resistance. The market comes back to it and then sells off. You know, the next example, 1, 2, 3. Market comes up, sells off again. So you kind of like a way you could use it is you could go and look at what's in premium pricing and discounted pricing and then you can look for fair value gaps to buy and sell off of. But remember, it is just an example. So here we have more examples, this time on Flipnova, which is our future trading platform. We do have a charting system. So here we have the same thing, 1, 2, 3, 1, 2, 3, and then the market comes back down to it, buys off and finds support there. On the second example, same thing, 1, 2, 3, the market is having trouble, like a wall, it's like a ceiling, it's having trouble to push off of, and then it finally goes down after touching that fair value gap. And if you want to be extremely precise, this is a really good example of just how precise fair value gaps are. You can barely see it, but there is a small gap between the first and third candle that they don't touch. And look at how precise these areas are. The market comes back down to it, respects it, and then it flies off. This is the 4-hour FCPO chart, so this is quite a large move. And this just shows that if you want to be precise with it, the fair value gap is actually an area of precision, of support and resistance. Keep in mind that these areas are expected areas of support resistance to base your entries on, but the overall trade context is still far more important. So do keep that in mind. All right, so let's get into the promotion section. Everyone loves promotions, right? So let's just get straight into it. So this is our current promotion, which is called Trade and Earn with Phillip, which means that the more you trade, you are winning you stand a chance to win up to around 1,800 ringgit worth of touch and go without pin, as well as other prizes like the iPads and the AirPods, as well as the Apple Watch. So scan this QR code for more information. And secondly, we have the Discover and Trade Singapore stocks with Phillip Capital, where if you trade Singapore stocks with us, you stand a chance to win an iPad Pro and more products. This QR code has all the information that you need, so scan it if you're interested in stocks, in Singapore stocks especially. All right, so this is the Q&A session. If you have any questions, do leave them in the chat for me to see so I can answer any of the questions that you may have. And I'm willing to answer all of it. So if you have any questions at all about trading or about anything that's in your mind right now, do let me know and I will answer your questions. All right, so we have one. All right, so which fair value gap to draw if there are more than one? Well, I'd say a good one is gonna like choose the one in premium or the higher one if you want to sell, and then the one in discount, which is the one that's lower for longs, because you want to buy as low as possible and sell as high as possible. Of course, that depends on the overall trade context, and price will always seek out higher or lower prices depending on if you want to buy or sell. But you have to know when to invalidate your trades. So that's a way you're gonna filter out. You could use the premium and discount concepts that I taught you just now. You're gonna filter out which fair value gap is the best one. Does that answer your question? Okay. All right. Are there any more questions? Oh, okay. I have one, which is, what's your advice for people to do to improve in trading? Okay, so I think you're asking me what should you do to improve in trading. I think to answer this question, I think we need to kind of know the main issue that most traders face, and that is a lack of confidence. When people they enter a trade, they don't know if that trade is going to work out, and they start praying for it to work out. And that's not a really viable thing because you're putting money on your trades, right? I'd say the most important thing is you have to know to journal your trades. Each time you take a trade, you have to understand that trading is a game of probabilities and statistics in the long run. You have to know the why behind you. You have to know the why for placing a trade, and you should not base your trades on intuition. You shouldn't think, oh, I click buy just because I think the market's going to go up. Why is it going to go up? What's your data set telling you? You have to reaffirm that with your own journaling. And so each time you take a trade from today onwards, each time you take a trade, write down what you thought going into the trade. Why did you place buy or sell? why did you buy and not sell it from there? And over time, you will have a large collection of information that tells you, that something that your strategy may work better certain ways or certain times. So just collecting data and information is the one advice I give to most traders, because I've met many traders, like many people that don't do any of these. And they've been trading for like 5 years and they don't know what they're doing at all. They're just they hear it from someone and then they don't confirm it themselves in the charts. So I think that's something people should look into doing, which is taking trades and then journaling them to collect data. So that's the one advice I give to most people. Do we have any more questions? If not, I have one more. All right, so it's do you prefer fundamental or technical analysis? Personally, I would prefer technical analysis because it provides you with things that fundamental analysis cannot. Because if you use fundamentals, essentially you are trying to forecast a market by factoring in things that will affect the markets. And I'm not saying that fundamentals are not important. They are well proven to affect, they are well proven in their effectiveness. The only issue that I have with them is that even though you know that gold is going to go up, you might not be able to know where to enter, because your entries and exits are just as important as why you chose to enter them. So I think that for me, if I had to choose one or the other, I would choose technicals, because there I could find patterns. I could look for things in the charts, like patterns, and then I can know where to enter and exit a trade, which I do not think fundamentals alone can give you. I could be wrong, but I personally, from what I've seen, that's not the case. But it's best to use both of them. It's not in the best case. In the best case, you should use both technicals as well as fundamentals. I hope that answers your question. All right. Are there any more questions? Okay. Any questions you'd like to ask, just let me know. What is the best time frame for FVG? Okay, so the best time frame for FVG is, the higher time frames are going to be more important, right? So the higher you go, the more important your zones are going to be. So just like the daily is always going to be more important than the 4-hour, and then the 4-hour is going to be more important than the 1 hour. So depends on your trading style, but I could just give you an advice on, using multiple time frames as confirmations so you don't get lost in just one. So that's the. Will you be able to share the slides presentations by email? Sure. If you want any of these slides, just send me an email, which I will leave my email or my group email later on in the presentation. You could just, I'll send you the slides, no issue. Can you repeat the part about commissions for FKLI and FCPO? Yeah, sure. I'll get to that after I answer some of the other questions at the end of this. How to use FVG and Confluence with major support and resistance. All right, so I'd say I personally don't use support and resistance, but let's just say you have an area of support that also has an FVG near it. I think that's a strong sign that that area is a really good area of interest. So if you have a support with a bullish fair value gap, then you could use the entire zone as your support area. Or if you don't want to use support, then you can use the FVG in alone, because that's what I personally do, and I find good success with it. That those are my areas of support and resistance, essentially. We have one that's, can we have a webinar about how to create a trading strategy? Yeah, of course, sure. Maybe in the future, in the near future, actually, we might do a webinar on an entire trading strategy, one that's complete. So do keep an eye out for that, because I am planning, those are in the plans, essentially, yeah. May you repeat how to backtest the support and resistance level? So yeah, so just go on to any of your charts on any time frame, and then just look for any fair value gaps, and then try to test out how many times they work out, how they look like, just trying to train your eyes to look at to look out for these zones, because I know that they are quite different from what people use as support and resistance. So I think it takes a long time, or at least some time, to train your eyes to spot them quite naturally. What is your advice for newbie before you start to trade? I think I may have answered that, but essentially just take it slow. Take it slow and understand that trading is like a long-term game. Take your time. Each time you can start off with demo trading, or if you want to trade like funds, just use a small capital to trade up, so you don't lose too much of your money. But remember, just take your time, practice. You don't have to get trading or start trading too quick. Take your time and then manage your knowledge on it, if that makes sense. And journaling is a big part of it. Are there any books recommended for beginner trader? Well, I know a lot of mindset books for beginner traders. But if you are looking for something like strategies and things, I'd say look for books from Larry Williams. He is a really well-known trader, and he has made or came out with many popular books. So Larry Williams on online is fine. Do you use Heiken Ashi candles as a way to trade? No, I do not use Heiken Ashi candles. I use just normal candlesticks. But I know people that do use Heiken Ashi, and they are finding success with it. So if it works for you, then continue on doing it. But I personally don't use it. Here is the email for. All right, sure. Let me. Okay. So, all right. So if you have any questions about the commissions, do send your email here for the commissions, and I'll contact you there on. Or if you want any of the slides, do let me know and send your email. Do we have any questions? Any more questions? I hope I answer your questions with enough information. All right, sure. So I will send all of you the slides if you guys request for me. Or if you have any questions, just drop an email to our email right here. So this is our online account opening process. Just scan this QR code and you can open an account with us. And this is where you contact us. Essentially, if you're interested in talking to us or in any of the content that we create, these are our handles online. And if you're interested in like slides, or if you want to ask me more questions, this is our phone number and this is the group email. So if you want slides, or if you want to know more on the products like FKLI or FCPO, you are welcome to email us at this email address. And if you're in Kuching, you can also visit us at the address listed down here. We're just opposite Timberland, so we are not that hard to spot, to be honest. So yeah, do we have any more questions? Which FCPO trading do you normally do, intraday or overnight? I personally do intraday trading. I am an intraday trader basically. I trade during the morning and afternoon session, and that's where I'm normally looking at the charts. I don't normally hold my trades overnight because I like to just get in and get out. So I only trade intraday. Yep. Do we have any more questions? All right, so I think that might be all for it. Well, if like after the webinar, if you just like have any questions, like maybe you're in the shower and you think, oh yeah, I should have asked Brian something just now. It's okay, you can contact me in that email, and I'll reply to your email any time of the day if you want. What time frame do you use for intraday? Well, I use the daily, the 4 hour, as well as the 1 hour for my main time frames. Sometimes I use the minute 15, but most times it's just the 1 hour and the 4 hour as well as the daily time frame. I use multiple time frames for confluence and confirmations. All right, so that should be it for this webinar. Thank you all for joining, and I hope this has been an eventful evening for you all. Thank you all for coming out. It's Friday night. It's been a tiring week for many of you, I'm sure. So it's not easy to be here listening to someone talk. So yeah, I'm really grateful for all of you for coming out. And any questions, contact us right here, and we'll get to you as soon as we can. All right. Thank you guys for coming, and I'll see you guys in the next webinar. Thank you.